Hi everyone, welcome to today's webinar hosted by the Trove team, where we will be reviewing the voluntary carbon market in 2022. The speakers for today's webinar are Guy Turner, CEO and founder of Trove Research, Gregoire Mazars, who is our lead analyst, Nick Hill, who is our senior analyst, Yelena Peshkatari, who's also our senior analyst, Delphine Stringer, who is our analyst, and myself, Ashni Patel, who leads client relations and will be hosting today's webinar. Before we begin, I would just like to go over some house rules. All attendees will be automatically muted. The first section of the webinar will be a presentation from the Trove team, followed by Q&A. So if you have any questions throughout the webinar, please insert them in the Q&A function at the bottom of your screens. The slides, along with the recording of this webinar, will be uploaded onto the Trove Research website tomorrow. So feel free to share these around with your colleagues and around your institutions. I will now hand over to Guy Turner, our CEO and founder, for a brief introduction of Trove.
Thanks, Ashni, and welcome to everyone far and wide around the world. For those of you who've attended our quarterly webinars before and our annual roundup in January last year, you'll be familiar with who we are, but just for those who haven't met us before, we are a specialist group of carbon geeks who have spent 2 years building a really comprehensive platform to understand how the world of carbon credits and corporate climate commitments works. We have a policy team. We've got representatives from all teams on the call today. We track all projects in the world. We produce forecasting scenarios on where we think carbon prices are going to go. We track all the corporate commitments in the world and also the transaction, the prices of carbon credits on a day-to-day basis. And 2022 was a very, very busy year for us. We've been beavering away hard here. Our team here has tripled in size. We launched a completely new platform. The policy team, whose arduous job it is to try and keep track of all of this crazy policy advice that hits the market, tracked over 850 updates. We launched country profiles to understand what's going on in the detail, particularly in host countries. We've now got 7,500 company commitments tracked. We've got a very comprehensive database of corporate credit retirements, so knowing who's buying carbon credits, when and where. Enhanced analytics across a number of the platforms on the supply side, looking at individual project developers. We also launched an AI-driven carbon price calculator, so you can understand what prices different types of credits are trading at. The scenarios report I mentioned, and a whole host of other things as well. So please do get in contact if you want to find out more about what we do. The hour session will be divided into 5 main sections and then Q&A. We'll have a quick run through of the policy and guidance themes that emerged in 2022, a review of the corporate commitments, the credits and transactions profile, so issuances and retirements, where carbon credit prices are at today and where they've come from in the last 12 months, and then a short-term market outlook for 2023, and then finally Q&A. And I just wanted to start off with my perspective. I've personally been in this field for well over 20 years, and give some sort of high-level remarks on what how we think about 2022. And I really think to try and explain 2022, we really need to go back to 2021 and sort of get a sense of where we came from. And I would certainly characterize 2021 as a very unique year. One very much linked to the emergence of the world economy from the pandemic. There was a huge amount of optimism built around that. And I think quite a lot of that filtered through into the climate world and the corporate world as well. If the world can solve to some degree a global pandemic, the size of which has never been seen before, then perhaps the world could get to grips with climate change as well. And there was a huge sense of optimism around COP26 in Glasgow, which was notable for two reasons. Firstly, it was this 5-year anniversary of the Paris Agreement, so the first year of a major revision and sort of stock take. And secondly, it had been delayed for a year, which gave us all another quite useful 12 months to plan and think hard about those commitments that would be needed. And it also heralded the start of quite a significant interest from the private sector. The TSVCM, the task force of scaling voluntary carbon markets, sort of kicked off. And along with that, it swept up a lot of positive energy at the corporate level, and also on the supply side. So capital started to flow. A number of funds started to raise capital to invest in the projects that would be needed to deliver the reductions. And that really created quite a heady brew. Retirements grew by 70% in 21 compared to 2020. And there was a lot of optimism to think that this could continue. Maybe unfounded. The war in Ukraine was a massive event globally, not just for our market, but obviously across the world in 2022. And I think that just gave everyone time to pause. And if I had to choose a couple of words to describe 2022 from the carbon market point of view, I would say it's about consolidation and really time to sort of engage in some housekeeping. As Delphine will allude to in the policy review, the industry's being challenged from a number of sides. I think some of that is healthy, some of it unwarranted, but this is the time to sort of do the hard yards. That optimism, the capital raising now needs to be translated into some of the more difficult and tricky areas. Project operations on the ground. Those of you on the call who are developing projects in far-flung countries will understand just how difficult doing these projects are. They take time, they take effort, they take commitment. And I think that's sort of like a key theme which comes through. In spite of that, though, retirements, as Nick will show you, retirements have not fallen back. They're broadly similar to where they were last year. And Elena will highlight the fact that in spite of the economic challenges, 2,000 more companies this year have set net zero targets, accounting for nearly 15% of world greenhouse gas emissions, including scope 3. And Gregoire will show you that prices are on average higher across the carbon credit complex in 2022 than they were in 2021. So there's a number of mixed signals. The market certainly hasn't retracted. It's gone forward in a number of areas. It's perhaps not progressed as far as many expected it to at the end of 2021. But I think those are all really pretty significant achievements, given that stock markets are on average 10 to 15% lower at the end of December last year than they were 12 months before. And there's a lot of tensions geopolitically in the world as well. So I think that is a very useful sort of way to start to think about what happened last year and where this year may end up. So let me just hand over to, or let me just sort of introduce the policy themes that we track. When we're thinking about trying to characterize what happened last year, we moved these into two buckets, so tailwinds and crosswinds. And the tailwinds really were event or trends that in the policy world that was supportive of growth in the carbon credit market. We didn't include any headwinds on the policy side. There were obviously headwinds on the economic side affecting everybody, but there were sort of what we term as crosswinds or sort of turbulence, buffeting the industry, challenging the industry. And we believe that some of those challenges are actually quite well intentioned, but still unresolved. So, generally it's sort of a positive picture. but if you're in the cockpit, you would probably be experiencing some turbulence. But the planes land in the end. So that's really just the backdrop. And Delphine, do you want to sort of lead us through a couple of more detailed nuggets?
Sure, thank you very much, Guy. And hello, everyone. Thank you for joining us today. In terms of tailwinds, several countries and regulators, including the US Securities and Exchange Commission, took steps forward to implementing and strengthening requirements for corporate climate disclosures. Although some states in the US have pushed back against ESG disclosures, we believe improved transparency and accountability will encourage companies to set meaningful climate targets, which will support the global carbon credit market. On carbon credit use, Guy, please could you adjust the slide? Thank you. Influential organizations such as VCMI, TCFI, and SBTI were all publishing major new guidelines on when and how corporates should use carbon credits. The VCMI's draft claim code of practice probably caused the greatest stir, with its gold, silver, and bronze categories. We actually think this categorization is helpful for the market, especially bronze, as it allows companies an on-ramp to setting climate targets. Even the likes of Carbon Market Watch, Stockholm Environment Institute, and the UN had strong views on how companies were making green claims. Again, while some may see this criticism as unhelpful, where it's well researched, we see the scrutiny as a necessary step to building trust in the market. Over the year, we've also seen a growing interest in biodiversity as part of the climate puzzle, with greater prominence on the TNFD, new standards from Bera and Plan Vivo, and the launch of the Global Biodiversity Framework at COP15. Some investors are also seeking specific project types to protect ecosystems and habitats, such as mangroves. The growing focus on biodiversity works in tandem with efforts to reduce emissions, so these are mutually reinforcing trends. Now we'll take a look at the crosswinds. The quality of carbon credits remains a key issue in the eyes of buyers, and whilst the Carbon Credit Quality Initiative and the Integrity Council for the Voluntary Carbon Market both released important proposals in 2022, definitions on what constitutes credit quality and how to achieve it remains contested. The ICVCM's core carbon principles in their draft form would be difficult to implement against older projects. And whilst the intentions are laudable and should be helpful in the longer term, a benchmark that few or no credits could pass could undermine the trust in the market entirely. Moving on to jurisdictional initiative, our view is that overall, they are positive for the climate, as governments have the finance to scale back, to have the finance and scale to make a difference. But it is unclear how national level programs will interact with the voluntary carbon market still. There is growing interest in jurisdictional credits, particularly in forestry, which my colleague Nick will touch upon. Several countries, including Ghana and Gabon, are exploring other ways in which they could receive funding for emissions reductions from forestry activities at the jurisdictional level. However, we cannot forget that careful oversight of jurisdictional baselines is needed to maintain integrity in the carbon markets. Interest in jurisdictional initiatives expanded beyond forestry at COP27, with the launch of the African Carbon Markets Initiative and the Energy Transition Accelerator, which was backed by the United States. Another key trend we witnessed in 2022 was countries beginning to think seriously about how they would achieve their NDCs and whether carbon credits will play a role. Some countries took steps to control the flow of credits while they work through this. My colleague Nick will also touch upon the impact of these measures on credit issuances. We look forward to seeing how these tailwinds and crosswinds play out in the coming year, but for now, let's have a look at the key things to look out for in 2023. Firstly, companies are facing increasing pressure to show how they will achieve their climate commitments, especially regarding short-term actions. In this context, we will keep an eye out for the finalisation of the Transition Plan Task Force's disclosure framework. Also in 2023, the SBTI will release their net zero standard for financial institutions. How the SBTI then decides how to address investments in fossil fuels and early stage carbon removal technologies will be critical to the standard's credibility and impact. We also expect to see further guidance on carbon credit use. After having published a series of blogs last year, there'll be more detailed guidance on beyond value chain mitigation from the SBTI. Companies need clear guidance on how to invest in carbon credits and other climate solutions, even while prioritizing their internal emission reductions. Moving on to bullet 4, we expect continued interest in biodiversity from countries and credit registries. We will be following the development of methodologies to measure the biodiversity impacts of carbon credits and to create a new type of biodiversity or nature credit to grow conservation funding. Penultimately, we anticipate a greater focus on high quality removals. In 2023, the European Commission will continue work on the proposed EU framework to certify high quality carbon removals. National governments are also weighing up how to quantify these removals. In addition to this, major registries and other initiatives are developing methodologies for generating credits from carbon removal activities. Lastly, as countries deliberate the role of credits in achieving their NDCs, we expect to see more Article 6.2 partnerships being negotiated, even though at COP27 the rules weren't finalised. Ahead of COP28, there still may be signs of progress on the rules after the key meetings that will take place in June. Now over to you, Jelena.
As Delphine mentioned, the tailwinds. Another positive trend in 2022 was the growing number of companies committing to take climate action. Trove tracks for our subscribers all types of corporate climate commitments and claims, covering, as Guy mentioned, over 7,500 companies. Now, we are also in the process of some exciting upgrades to subscriber dashboards and reports, which will be launching in the coming months. So watch this space. However, in this webinar, we focus our updates on the number of companies committing to and setting science-based target initiative targets, which is considered the highest quality of corporate climate targets. As shown on the chart on the left, last year, about 2,400 companies had their climate targets validated by SBTI or committed to do so in the next 2 years, taking the total number to over 4,200 companies. The 2,400 new companies have around 16 gigaton CO2 emissions when including Scope 1, Scope 2, and Scope 3. Remarkably, this equates approximately to 20-25% of world greenhouse gas emissions, again, when including Scope 3. Now, the continued growth in the number of companies committing to take action on climate can be considered a really positive development, actually, given the global geopolitical and economic challenges the world faced last year. However, whilst it was an overall positive picture, it is also worth noting that there was a slowdown in the pace of growth in the number of companies committing to make an SBTI target in the second half of the year, which may be a reflection, as I said, of the geopolitical and economical situation starting to impact corporate planning, as it is shown on the graph on the right-hand side. Now, SBTI launched its net zero standard in October 2021. And in 2022, just over 1,000 companies committed to the standard, with just over 100 of those companies have now had it validated by SBTI. These included, as shown by the logos on the right hand side box, some companies from heavy emitting industries, such as airlines like Delta Airline, Lufthansa, cement industry, Cemex, Heidelberg Cement, power generation like Eneco, Iberdrola, Chess Group, and so on. Now, all these companies have committed to be net zero, not just simply zero, which means that at some point they will need to purchase carbon credits. So I will now pass on to my colleague Nick, who will update you on what actually happened in the credit market last year. Over to you, Nick.
Thank you, Elena. So now I'll be taking us through our end of 2022 numbers for the supply of carbon credits to the VCM, and hopefully providing a bit of insight into what's happened in 2022 and what we might expect looking forward into 2023. So straight off the bat, you can see that issuances across the 7 main project types tracked by Trove were down by about 14% in 2022. In particular, RED Plus issuances were down significantly compared to 2021, and we are attributing this to moratoria on the issuance of RED Plus credits being introduced by governments in Indonesia, Papua New Guinea, and Honduras. However, in recent news, Rimba Raya has had partial validation from the National Registry of Indonesia, the SNR, and we may therefore expect to see a bit of a recovery in RED Plus issuances in 2023. Following on from this, however, late last year, Guyana issued 33 megatons of the first ever jurisdictional RED Plus credits, giving a late bump to the numbers and leaving the total issuances down by only 6%. On the topic of jurisdictional RED Plus credits, Costa Rica submitted their monitoring report last October and could well be the second country to issue JRED credits. And it will be interesting to see how this type of RED Plus credit evolves and grows throughout this year. And just to clarify, under jurisdictional RED Plus, we currently only track trees credits and issued by ART and not any other credits, any other crediting or results-based payment schemes. So the yearly graph doesn't show the whole story, and you can see from the quarterly graph that there has in fact been a fairly steady decline in issuances since the second quarter of 2021, with a surge of issuances concentrated in Q4 of 2022, and even then it was mostly in December. So it's really quite difficult to draw any definitive conclusions from this, and so we're looking forward to seeing if any clear trends emerge in 2023 with regards to issuances. In general, and as Guy mentioned earlier, retirements were steadier than issuances last year, with a 2% increase in total retirements to 173 megatons. Here you can also see again that RED Plus retirements declined quite significantly, but this was offset by an increase in popularity for renewable energy and energy efficiency credits. However, in late 2021 and early last year, we saw a surge of credits being tokenized and retired, accounting for about 17 megatons in 2021 and 6 megatons in 2022. The main reason why interest in these types of credits has fallen is because of a broader retreat from crypto-based assets in 2022, and serious questions were being raised around the quality of the credits that were being used. In addition, some registries in Q2 of last year made moves to limit or ban tokenization of credits and have launched consultations on how they should interact with tokenization in the future, the results of which we'll look out for in 2023. So for the purposes of analysis, Trove has chosen to exclude these tokenized credits. And when we do, we have an 11% increase in retirements in 2022 from 152 megatons to 168 megatons. From these retirements, it's been really interesting to see that there's been a significant shift towards more contemporary vintages in 2022. Generally, you might expect that the average vintage year of a retired credit would increase by 1 year every year. And yet you can see from 2020 to 2021, that's not really the case. However, last year, the average retired credit vintage year increased by about 3 years. From 2015 to 2018, and it will be, again, interesting to see how that trend holds up going into 2023. So that's what happened with retirements overall. And I'll now hand back to Yelena to talk about who's been doing the retirements last year.
Thank you, Nick. So in addition to analyzing market level retirements, as Nick just described, at Trove, we spent a lot of time actually last year creating the world's largest database of corporate level retirement data, drawing on multiple publicly available sources, including the major crediting registries, CDP, and from corporate reports themselves. Looking at the data that has so far been published by the registries in 2022, the largest corporate retirees are all relatively well-known credit purchases and carbon neutral claimants. The top 10 retirees were responsible for around 16% of all retirements last year, up from 12% in 2021, suggesting that the market has somehow become marginally a bit more concentrated. Now, the largest buyer last year by some distance, as you can see in the chart, it's Delta Airlines in the US, which actually has claimed the top spot, apologies, the last 4 years out of 5 years. Delta Airlines retired a range of mostly non-nature-based credits last year, with vintages ranging from 2021 all the way back to 2000. Now, this choice of credits by Delta has been the subject of some recent negative press. And without going into too far into details into the pros and cons of like a single firm's climate strategy, one must reflect that Delta is one of the few airlines actually around the world to currently be deploying some serious funds towards attempting, or at least partially trying to mitigate its climate impact. Now, as we can see in the chart, only one other airline, EasyJet in the UK, made it to the top 10 retirees last year. However, it made the headline in December, and it was subject of a blog by Trove also, when it announced that it would stop purchasing credits and instead refocus its climate strategy on seeking technology solutions to achieving its net zero by 2050. Now, it remains to be seen whether this should be viewed as a simple and effective change on climate strategy by EasyJet, or more of an excuse to dial back its financial commitments in response to a collapsing share price and its poor financial results. Now, the other most prominent sectors amongst the largest buyers of credits are big energy and oil and gas firms, with, as we can see in the chart, with Eni, Shell, Diamondback Energy, and Tokyo Gas, all in the top 10. Now, with the exception of the Diamondback, which purchased very old US-based carbon capture and storage credits, the other companies seem to favor the purchase of nature-based credits. Now, I could go on for like probably much longer on what we saw last year, but conscious of time, I'll pass back to Nick to summarize what all these retirements actually mean for the supply of outstanding credits in the market. Nick, back to you.
Thanks, Elena. Yeah, so the overall result of all these issuances, retirements and retirees is the resultant surplus of credits that are available to the market. And as of 2022, that stands at 751 megatons. I'll spare any further analysis. This is a smaller year-on-year increase than that of 2021, both in percentage and volume terms. And for more extensive analysis, I would encourage subscribers to go read our 2022 gap analysis report, which is available on the Trove platform. And then from this, we have one of the most interesting stories of 2022, which was the dramatic increase in pipeline capacity. The pipeline tracks the estimated annual credit issuance of projects that have not yet been registered. And last year, it more than doubled in capacity from 200 megatons a year to 529 megatons a year. So not all of these projects will become registered, but some of the largest projects ever by estimated annual credits did enter the pipeline last year. And we look forward to keeping track of their progress and success. Importantly, the massive increase in capacity points to a growing investment in carbon projects, but is certainly a challenge for the registries who now need to start responding and start tackling what is starting to become a large backlog of projects. And then finally from me, next slide. Last year, there was also a significant increase in interest in high-tech, high-permanence removal technologies. In particular, capital invested in these types of projects rose by more than 10 times, with a 5 times increase in purchases and pre-purchases of these removal credits, and a further $925 million committed by Frontier. However, despite this interest, the real impact of these technologies remains small. So out of about 170 megatons retired in 2022, only 37 kilotons or 0.02% of CO2 could be attributed to these projects. And I'll now hand over to my colleague Greg, who will talk about carbon credit prices.
Thank you, Nick. Hello, everyone. So a lot of our work at Trove consists in receiving information on trades from market participants, both on exchanges and over the counter, and aggregating these into weighted averages and analyzing movements from one period to the next. On this chart, you can see that the average price across all credits in the market in 2022 was of $8.8 per ton, or a 40% increase from the average of $6.3 per ton in 2021. So prices rose quite substantially during the second half of 2022 across most types of credits, and in particular after COP26. But as you all know, the Ukraine war started during Q1 2022, and subsequently prices stagnated or declined throughout most of the year. As a result, the USD market price decreased 15% from Q4 2021 to Q4 2022. However, the dollar appreciated stronger last year. And so for the many buyers of credits who are based outside of the US, the price fall they faced through last year was actually smaller, namely only 10% in euro, 15% in British pounds, and 4% in Japanese yen. This fall in prices carried even more clearly across standardized contracts from exchanges, with some flagship contracts like NGO and GNT Plus for nature-based credits diminishing by 35 and 19% respectively from Q4 2021 to Q4 2022. And GO and GNT for CORSIA eligible credits, that's for airlines, diminishing by 54 and 30% over the same time period. Now, these declines were even larger in the percentage terms if you were to look from peak to trough. And this is because of a combination of factors leading to and flowing from low liquidity in these contracts. So in fact, they typically end up being used either for positioning or hedging more than anything else. As of today, this might change, but the price fall last year was less extreme in the indices we created at Trove. If you don't mind going to the next slide, thank you. Using data both from exchanges and OTC trades, although there was some variation across different project types, as we call them. You can see that the premium for nature-based credits, which we had predicted in 2021 and which really widened after COP26, remained true throughout the year. There were a few large trades of low price credits of older vintages, mostly for nature restoration, which sold in December, and that's why you see a big drop here. But it was very temporary, and we have seen nature restoration prices rebound so far in January. Not only that, but the injection of blue carbon credits in the market is very much carrying nature restoration prices upwards. Now, reduction technologies like non-CO2 gases, energy efficiency and fuel switch, and maybe to an extent renewable energy as well, experienced a lot more volatility this year, notably because some popular substack of these technologies experienced, let's say, upticks and downturns in demand during certain months. For example, landfill or clean cooking projects. And here again, it will take some time before these project types stabilize around a price range that consistently breaks above $10 per ton average. We go a lot more into detail on our online dashboard and our weekly reports. So if you're interested in further analysis of these movements, please contact us and we'll set up a demo for you. Please feel free to ask any questions in the chat, and I'll pass it on back to you, Guy, to explain what these price movements had to do with the overall market size and how that might develop in 2023.
Thanks, Gregoire. Yeah, so bringing together everything that we do in retirements and issuances and retirements and prices, when we start to multiply those factors together, we can understand, the total market size in dollar terms. Now, these numbers that we track here or publish are primary market, so literally the volume retired multiplied by the price of those credits that are retired. Last year, the total market size, according to that calculation, so this ignores the additional churn in the market. So typically a multiplier of 2 or 3 times might be applied to these numbers to get the total volume of transactions or market value of transactions. But about $1 billion was the primary market size last year. This year, we're looking at about a $1.3 billion. We had published a figure saying it was a $1.2 billion, but the late surge at the end of December in retirements that Nick alluded to just bumped that up to a $1.3 billion primary market size. And you can see the prominence of nature-based projects in that. More than half of the market value now being dominated by nature restoration and REDD+. Next year, we've made some estimates on where we think the market may end up next year from a total market size point of view. Base case would be about $1.6 billion, but could anywhere between staying flat at about 1.3 or maybe moving up to 1.9, depending on assumptions around the volumes of the volume of retirements and the prices. I think one of the interesting things to note is that when retirements start to increase, it's not a one-to-one relationship between retirements and prices. An uptick in retirements does lead to, because market could be quite tight in the short term, it can lead to more material price increases, particularly for certain types of projects. And as Gregoire was saying, we saw that with blue carbon towards the end of the year and Q4, regularly hitting $20, $30 a ton. And I think we should expect to see more pockets of those kind of highly desirable projects sort of coming to the fore. And the more volumes that come through on those projects, the more that will lift the weighted average price at the same time. But at the same time, there is still, as Nick said, 750 odd million tons of surplus of older vintage credits. Whether those are regarded as desirable will sort of I think affect the weighted average price on the downside, just simply the sheer volume and the low cost of supply. So that's sort of a little bit of early crystal ball gazing. For those who are part of the Trove subscribers, you'll be aware that we have a much more sort of complete longer term price scenarios forecasting process, where we put out different scenarios on reduction credits, removal credits under multiple different scenarios that calculate prices over the next 10, 15, 20, 30 years. So this is just a very, very near term sort of perspective. And hold on that point, we thought it would be quite helpful for those who've been part of the webinars, the quarterly webinar process that we've run for the last 12 months. You'll be aware at the end of the webinars, we ask people what they think, where they anticipate prices ending up towards the end of the year. So we thought we'd play that back to you on the basis that the wisdom of the crowd has some validity. Well, not casting any aspersions on the crowd got it wrong a couple of times. So maybe it wasn't as wise as we might have thought. So these are the results for the polls that we did in the end of Q1, Q2, and Q3. Where the question was, where do you think the price of these credits will end up at the end of the year? And this is for renewable energy and energy efficiency. So we just bundled all these together, and it does include a big bundle of project types. So also includes cook stoves in this. But there were some really optimistic expectations towards on the upside. And it actually turned out to be 4.7 for renewable energy and energy efficiency 6.2. So well below the mean or the median expectations from the previous quarterly surveys that we did as part of these webinars. For REDD+, now bear in mind that these results, the vertical red lines, are where the market ended up at the end of the year. And as Gregoire showed, it has fallen since the first half of the year. So if we were to have taken like the midpoint, we would be closer to the central part of the distribution. Probably not on it, but closer to the middle. And so for Red Plus, the market, yourselves, the wisdom was a little wiser, and the outturn was about $10.7 average for Red Plus, and the median expectation would be, you know, between 11 and 14. So again, come off. Now, bear in mind that the first half of the year, we were only just starting to come to terms with the Ukraine war. We didn't quite know how long it would last. We didn't know what the ripple effect would be in the economy. So, you know, it's easy to be wise after the event. And, you know, that's part of taking snapshots of forecasts through a period of time. And then the final one on nature restoration, for good reason, for all the, you know, the nature restorations are such important projects to restore nature. They cost more than many other project types because of the cost of land and labor and seedlings. And you know, the expectations were they would come in at a higher price, but you know, we didn't necessarily see that. And I think one of the reasons is there was some quite old. There was one in particular old restoration project in the subcontinent that was eligible to produce credits, which weighed down on the weighted average nature restoration price, particularly in the last sort of quarter. And so that sort of part explains that. But again, sort of, you know, you can see the actual outturn being somewhat less than the optimists were saying earlier in the year. So that's what happened in the past. We want to ask the same question again. Ashni, can I hand back over to you?
Yes, of course. So now we will quickly just do the poll for this year or this quarter. So you're just going to see the poll pop up on your screens at the moment. So if you could just spend a couple of minutes, please, putting what you think is going to happen, that would be great.
Ashley, should I stop sharing my screen?
No, it's all good. It will pop up on top of that.
Oh, okay. Aha.
Yeah, it does.
So we'll just give you a minute or two to fill this in, and then we will come back to the slides.
So we've changed the structure a little bit. We've separated out clean cooking from energy efficiency and renewable energy. So it's a slightly different structure this year. Trove people not allowed to vote, please. This is audience participation only. Probably the largest survey of the voluntary carbon market that there is, I suppose. If we're up to 200, up to 300 participants now. So renewable energy. Very different. We're starting to get this is more like a Poisson distribution for the stats out there, rather than a normal distribution. It's very interesting, very much left skewed.
Okay, so I think we will pause it there, and we will be relaying the results of this poll in the next webinar that we do.
Well, hold on, Ashni. I think we can actually see them now because they're live on the screen. We can actually see the results, I believe. Can people see the results?
I believe that's just for the panelists, guys. So we'll relay them in the next webinar.
Well, I might just give a quick voiceover for the groups for the audience. The modal, i.e. the most frequently voted price band for renewable energy credits, I thought the audience could see these, is in the $3 to $6 range. So that's where do you expect the price to be at the end of this year for renewable energy credits? 53% say $3 to $6. 29% say 7 to 10. So it's a pretty good left-tailed distribution actually. For clean cooking, the modal, i.e. the most voted, is 41% at $7 to $10, and then evenly split between some pessimists at $3 to $6, and 25% at $3 to $6, and 25% of the participants thinking 11 to 14, but still with some optimists coming in at 15 to 18, even 19 to 22. On Red Plus, it's much more of a normal distribution around the median of $11 to $14. So interesting that Red Plus is expected to trade higher than clean cooking by the end of this year by about on average $3, $4 a ton. And then quite a nice distribution on the downside and the upside around that median point of $11 to $14 per ton, some going up to $20, some going down to $3. And then finally, nature restoration, again, a more evenly distributed price curve, pretty much evenly split between $11 and $18, quite a wide range there. 30% of people thinking 11 to 14, 30% thinking 15 to 18, and then pretty much tails down to the bottom end and then rising to $26 on the upside. So, some quite interesting perspectives there. And that is the vox pop of 485 market participants on the call today. So we'll publish that in due course. And Ashley, thank you for running that.
No worries. We actually figured out how to relay the results on the screen so the participants could actually see that towards the end.
Oh, brilliant.
We over anyway. So yeah, thank you for that.
Thank you. Do we have time? Do you want to curate some of the Q&A then, Ashley?
Yes, we do have time for some Q&A.
I'll stop share so everyone can see our lovely faces.
So the first question we have is that we highlighted the issuance of jurisdictional Red Plus credits as a key theme from last year. A few of our listeners are asking if we can clarify what we mean by that or what the characteristics of that is. So perhaps over to you, Guy, or Lucien on the call.
Yeah, I'll have a quick stab and then Lucien, you can follow through. Really, it's everything that sits above the project level crediting process. So it could either be sort of state level, but mostly national level, where the process for generating the credits, occurs at that level. The baselines are set at the national level, and the calculations of the carbon stocks and sequestered or preserved are done at the national level. And the thing about those processes, they have to be done they can produce large volumes of credits. And if they're done well, as we said at the start, that's a good thing for the planet. Governments can control deforestation rates. They can, if they've got the will, engage in large scale nature-based programs. So that's a good thing. The risk is that where they're not done, where the crediting process isn't done diligently, that large volumes of credits can be produced. And if that just needs to be mindful of how that, if they're bought and then used as offsets or an alternative to mitigation somewhere, that they are absolutely 100% high quality. Lucien, do you want to comment on that?
Yes, thanks, Guy. Hi, everyone. I think that the key difference, as Guy explained there, is that these are credits that are based on the efforts of a government, either a state level or a national level government in a particular jurisdiction to reduce deforestation. So one of the key criteria there that means that people often would consider jurisdictional credits to be advantageous is that the risk of leakage of deforestation activities being displaced elsewhere instead of actually being stopped is reduced because your program of activities is taking place over a much larger area in terms of an entire state or an entire country. So that's probably one key reason I'd like to highlight for everyone on the call why you're seeing in certain cases, for example, when the SBTI are discussing beyond value chain mitigation, that certain organizations are promoting jurisdictional Red Plus credits as having different characteristics that in many ways might make them higher integrity or higher quality. As Guy said, depending on the standard and the certification process that is followed.
Perfect. Thank you, Lucian. And thank you, Guy, as well. So our next question is about the surplus of the credits in the market. So we can see that the volume of surplus is growing. Do Trove have a view on the volume of credits in the market that are likely to be stranded or never sold? Will registries or other bodies move to remove or ban very old vintages of credits in the future?
If I could just pick that one up quickly, Ashley. For those who've known us from our sort of inception over 2 years ago, we published a report on the surplus. It was the first report we ever published. It had a big iceberg on the front. You can find it on our website, on the public website. And it highlighted the surplus. And we thought about 3 ways in which that surplus could be managed, because we don't think that that long tail is helpful. One was if it buyer-led. So buyers actually take a view as to what good looks like and what is attractive for their purposes. And one suspects that over time, as Nick said, the more recent vintages will become more attractive, and that is what's happening on average. There was an increase of 2 or 3 years of average vintage traded in the market or retired in the market over the last year. So that trend is sort of already there. The other mechanism would be supply-led, so sort of registry-led, and I don't think that's really very likely. The standard-setting bodies and the registries sort of taking action on this. This has been discussed at that level quite a lot, and I don't think there's much appetite for doing that. If not, there's no legal contractual way in which they can do so. And the third area would be some sort of independent governance group, maybe ICVCM or CCQI or something like that, that would sort of opine on some kind of vintage cutoff or something like that, or quality cutoff. And the discussions are at a very early stage on that. And I of all of those 3, my guess is that the most likely and most route would be buyer-led in terms of what good looks like. And I think that is, that's what we've seen in the market today. I don't know if anybody else on the team wants to comment on that.
Okay, well, I guess we'll move on to the next question then. So this is a question for Gregoire regarding prices. So we've had a few questions come in asking how vintages affect the price of credit. So if you could maybe highlight your thoughts on that, that would be great.
Yeah, it's pretty straightforward. Recent vintages are associated with higher prices on average, notably amongst other factors because methodologies used by registries to develop these projects are improved over time. And so they become just simply stronger and more accurate in terms of accounting co-benefits and such. This correlation will most likely continue, although this shouldn't be thought of as a rule that is unbreakable, right? You might have more recent vintages with more affordable prices and vice versa. If that makes sense.
Perfect. Thank you, Gregoire. I think we have time for one more question. So maybe a final one for you, Guy. Bruce has asked, what do you see as being the greatest risk or risks to the development of the VCM in 2023? So I think it's a nice way to end off the webinar as well.
Thanks, Bruce. Nice one to end. I would have said earlier in the year, I would have thought the state of the economy would be the greatest risk, sort of 6 months ago. I'm actually less convinced of that now. I think you've seen, as shown in this webinar, the resilience of the market during some pretty turbulent times during this year. You can just look at the statistics economically. GDP is world GDP fell from 6% in 2020 to 3.7% in 2020, 2022 to 3.2% last year. So it's declining. There are concerns in many countries. You know, we've got, I don't know if people happening in other parts of the world, but we've got half of the public sector on strike in the UK at the moment. So it's, you know, these are tough economic times, but the market seems to be holding up in that. I think the greatest risk, and we've said this for a while, is that we don't resolve the question of integrity quickly enough. We will get there, but I think we need to just reverse the media dialogue on quality and greenwashing. I think that there are a lot of well-intentioned companies out there trying to do the right thing, putting their necks on the line to engage in mitigation beyond their value chains, and putting money to deploy it. And when they're trying to do the right thing and it comes back to bite them because a journalist has an attack on them, I think that's unhelpful. And some of those, as we said at the start, some of that scrutiny is actually really helpful in the longer term. But in the short term, you know, I think there's a risk that some companies will say, you know, is it better? Is this a battle we want to fight? And I hope that's not the case. So I think it's incumbent on the industry, on us all, to sort of tighten up wherever we can, and showcase the good things that are happening on the ground, and counteract the negative press with that.
Great, thank you so much, Guy. And thank you to all of the analysts who've contributed to today's webinar. And thank you all for joining the webinar as well. Just to reiterate what I said at the beginning, the webinar has been recorded, and the slides, as well as the recording, will be available on the Trove Research website tomorrow. So keep an eye out for that as well. Thank you all. Have a lovely rest of your day, and we look forward to seeing you in the next webinar.